I've got about 30% of my money in SCHD, just like many of you watching this. What I discovered in the last 48 hours about SCHD will completely change how you think about this fund and why the recent crash might be the best thing that could happen to your portfolio. The brutal reality check nobody wants to face. If you own SCHD or you've been thinking about buying it, this video could save or make you thousands of dollars. I'm in the same boat as you, watching my SCHD position get hammered while everything else seems to be going up. Here's the painful truth right now. SCHD sits at $26.39, crushing down from its peak $29.72 back in March 2025. While we're sitting here watching our accounts bleed, the S&P 500 has actually declined about 5% year to date. And even the Nasdaq has faced significant volatility with tech stocks getting hammered. SCHD announced its Quarter 2 2025 dividend at $0.2602 per share, a massive 4.58% jump from the previous quarter. The stock dropped 10%, but cash payments increased 5%. This exact setup created millionaires in 2022 when SCHD crushed the S&P 500 by 15%. The four crushing forces destroying SCHD and why each one is about to reverse. Force number 1, the terrible timing of the March 2025 reshuffling. SCHD's annual rebalancing happened at the worst possible moment, right when trade war fears and market chaos were at its peak. The fund was forced to dump solid defensive companies and buy others that immediately got crushed. SCHD's rebalancing doubled energy exposure from 12% to 21%. Energy companies trade at decade-low valuations with oil at $72 per barrel. Force number 2, the energy sector explosion that nobody sees coming. While energy sectors have been hurting SCHD's short-term numbers, oil companies are quietly setting up for the biggest comeback in years. Energy stocks are dirty cheap right now, and SCHD's massive 21% energy allocation is like sitting on a powder keg waiting to explode. Force number 3, the high-yield savings account massacre. This is probably the most brutal force hitting SCHD right now. High-yield savings accounts are screaming at people with rates up to 5% APY, while treasury bills offer around 4.5% with zero risk. Here's what my wealthiest clients keep telling me. When you got serious money, you stop caring about squeezing out every last drop of growth and start focusing on wealth protection. The same psychology drives massive institutions. They're parking money in guaranteed returns right now. Those 5% rates are crashing. Markets dropped from 5.40% in January 2025 to 4.60% today. ALI fell from 4.35% to 4.20% this month. The Fed meets July 29th to 30th, 2025, when rate cuts accelerate. Savings rates disappear. Force number 4, the sector allocation nightmare. SCHD is massively underweight in large value by 15%, and its biggest holdings are in healthcare and consumer staples. Literally the worst performing sectors of 2025. The fund is basically invested in everything that's getting crushed. But this is exactly why contrarian money is getting excited. When these defensive sectors rotate back into favor, SCHD could see explosive 20 to 30% moves overnight. The total performance reality that changes everything. Remember, stock price movement and total performance are completely different animals. Most people look at SCHD's brutal price action and miss the bigger picture entirely. If SCHD drops 5% but pays out 4% in dividends, your real loss is only 1%. When you reinvest those dividends back into more shares, especially at these beaten down prices, the compound effect becomes absolutely massive. Here's the data that shocked me. SCHD has delivered a 10-year dividend growth rate of 9.33% annually. Combined with roughly 7.53% average price appreciation, that combination has created serious wealth over time. If you bought SCHD in 2011, accounting for the 2024 stock split, your yield on cost today would be 10.6%. Today's dividend yield is 3.88%, demonstrating incredible dividend growth compounding. The shocking performance data everyone's missing. Early 2025 has been brutal. 90% of category funds are beating SCHD, but even in this catastrophic year, total return including dividends is only down 1.39%. There are countless people posting comments everywhere saying SCHD is garbage and this fund never moves. But just last year, it delivered only 11% total returns, and right now, in what everyone calls SCHD's worst year ever, it's only down about 1.4% when you include dividend payments. What the smart money is doing while you're panicking. The contrarian setup. SCHD's massive underweight to large value by 15%, combined with its heavy allocation to healthcare and consumer staples that have been the market's biggest losers, positions it perfectly for the eventual sector rotation. The technology hedge. Eventually, if technology stocks hit a major correction, and AI companies always do eventually, everyone will hate growth investments and love SCHD because it has minimal technology exposure. The institutional strategy. My clients with substantial wealth and building diversified 3-fund portfolios, and SCHD remains a core holding because they understand something retail investors don't. True diversification across time and market cycles. How to position yourself right now, based on your specific situation. Most importantly, this is your money and your portfolio. You need to determine what matters most to you. Do you prioritize cash flow? Do you want price appreciation? Are we talking about retirement accounts versus taxable investing? What's your risk tolerance and investment timeline? If you need short-term results, if you require access to this money within the next year or want rapid growth immediately, SCHD probably isn't your best option right now. I completely understand the frustration with a 1% loss if you need quick performance. If you're investing for the long haul, this fund has consistently proven itself over 14 years, which is exactly why it remains a core holding in my personal portfolio. Alternative number 1, for higher income, consider JEPI or JEPQ covered call funds. But be careful, most ultra-high yield funds are yield traps. Alternative 2, for maximum safety, use high-yield savings at 5% APY or Treasury bills. Remember, these rates drop when the Fed cuts. Alternative 3, for growth, get broad market exposure with VOO or go aggressive with QQQ, SCHG, or VGT. Just understand that I hope you approach this carefully. Those growth investments are extremely hot right now, but I get concerned when people say, I'll go 100% growth mode and then switch to dividends later. That timing strategy isn't guaranteed to work. My personal approach and what hundreds of my clients are implementing. The strategy I've used to build my portfolio and the hundreds of my clients are successfully implementing involves constructing a customized 3-fund portfolio based on your risk tolerance, timeline, and specific financial goals. Conservative approach. 40% SCHD, 30% Treasury bonds, high-yield savings, 30% broad market exposure. Moderate approach. 30% SCHD, 40% broad market funds, and 30% growth-focused investments. Aggressive approach, 20% SCHD as stability anchor. 80% growth-oriented investments. The critical element is quarterly rebalancing and maintaining discipline about your allocation regardless of what's performing well or poorly in the moment. Why this opportunity disappears soon? Here's what's happening behind the scenes that most retail investors never see. Cyclical sectors, including financials and energy, are gaining momentum in anticipation of favorable regulatory policies. SCHD's heavy energy allocation positions it perfectly for this transition. The smart money isn't waiting for SCHD to recover. They're accumulating shares while retail investors panic about temporary underperformance. When the next major recession arrives, and it always does, SCHD will demonstrate its defensive value again, exactly like it did in 2022. At that point, everyone will love SCHD and hate growth stocks. But you'll have missed the optimum buying opportunity. This is educational content only. Always consult with a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. Please like this video and subscribe. Here's to your investing success. Profit.